Best high dividend stocks you should buy in 2024 for beginners. Are you looking for high dividend stocks that you should consider in 2024 to secure your financial future as a beginner investor? In today's video, we'll explore 5 high dividend stocks that offer both stability and the chance to grow, perfect for new investors. Whether you're just starting or want to boost your investment skills, knowing which stocks can give you steady returns is key. Stick around until the end for a bonus tip that could take your investment strategy to the next level and help you get the most from your money. Let's start with stock number 1, utilities for stability. When considering investment options, utility stocks stand out as a strong choice for those seeking stability and consistent income. Companies like Duke Energy and NextEra Energy exemplify this sector, known for their reliable dividend payments. Utilities provide essential services such as electricity, water, and natural gas, making their revenues relatively stable even in challenging economic conditions. The demand for utilities remains steady because people rely on these services in their daily lives, regardless of the broader economic climate. This reliability means that utility stocks often maintain their value during economic downturns, making them a favorite option for conservative investors. By investing in utilities, you can enjoy the benefits of passive income without exposing yourself to excessive risk. For new investors, utility stocks are an excellent entry point. Their predictable returns and stability make them an ideal foundation for any dividend portfolio. As you build your investment strategy, consider including utility stocks to provide a consistent income stream, ensuring a more secure financial future. Ultimately, the combination of stability and reliable dividends makes utility stocks a wise choice for long-term investment. One well-known investor who employs a strategy focused on utility stocks is John Neff. As the former manager of the Vanguard Windsor Fund, Neff became famous for his value investing approach, which included a significant allocation to utility stocks. His investment philosophy emphasized identifying undervalued companies with strong fundamentals, particularly those that offer consistent dividend payments. Stock number 2, real estate investment trusts, REITs. Real estate investment trusts, commonly known as REITs, are companies that own, operate, or finance income-generating real estate. These entities play a significant role in the investment landscape, as they are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This structure often results in high dividend payouts, making REITs an attractive option for income-focused investors. Investing in REITs allows individuals to gain exposure to large-scale real estate projects without the responsibilities and challenges of owning physical properties. For instance, well-known REITs such as Realty Income and Vanguard's REIT Index Fund enable investors to diversify their portfolios across various real estate sectors, including residential, commercial, and healthcare properties. This diversity not only helps mitigate risk, but also enhances the potential for stable returns. One of the key advantages of REITs is their ability to provide passive income. As investors receive regular dividend payments, REITs can serve as a reliable source of income, particularly for those looking to supplement their earnings or plan for retirement. Moreover, REITs can be a smart choice for individuals seeking to diversify their investment strategies. With options available in different sectors, there is likely a REIT that aligns with your investment goals and risk tolerance. One well-known figure who has successfully utilized real estate investment trusts, or REITs, as part of their investment strategy is Warren Buffett. While Buffett is primarily known for his value investing approach through his company Berkshire Hathaway, he has also acknowledged the merits of investing in REITs for generating income and diversifying portfolios. Stock number 3, consumer staples for reliability. Now, let's talk about consumer staples. These are the brands that are part of your everyday life, like Coca-Cola, Procter & Gamble, and Johnson & Johnson. It's easy to see why they stand out. No matter how the economy is doing, people will always reach for household products. This makes the consumer staples sector a reliable choice for investors looking for stability. A well-known figure who utilizes a consumer staples investment strategy is Jack Bogle, the founder of Vanguard Group. Bogle is celebrated for advocating low-cost index investing, which often includes a focus on sectors like consumer staples. He emphasized the importance of investing in stable companies that provide steady dividends, particularly during market volatility. You may wonder why these companies are often recommended for new investors. One of the key reasons is their track record of steady dividend payments, even when times get tough. During recessions, while many other sectors may struggle, consumer staples companies continue to generate strong cash flows. This reliability means they can provide you with consistent passive income, making them a safe haven for your money. So if you're just starting out on your investment journey, consider this sector. With consumer staples, you're not just parking your money. You're investing in something that stands firm through all market cycles. Stock number 4, financials for growth and income. Big banks like JP Morgan Chase and Bank of America aren't just well-known names. They also offer impressive dividend yields that can enhance your income. These financial giants have the potential for both growth and income, making them attractive additions to your investment strategy. While financial stocks can be more unpredictable than those in the utilities or consumer goods sectors, this unpredictability often comes with higher rewards. Despite their fluctuations with market conditions, financial stocks provide a compelling balance between dividend income and the possibility of appreciating value. Including these stocks in your portfolio can diversify your investments and give you exposure to a sector that plays a crucial role in the economy. This can be especially beneficial for investors seeking to mitigate risk while enhancing potential returns. A notable investor who effectively employs this strategy is David Einhorn, founder of Greenlight Capital. Known for his value-oriented investment approach, Einhorn frequently includes financial stocks in his portfolio, focusing on companies with strong fundamentals that offer both dividend income and growth potential. As you consider your options, remember that investing in financial stocks can be a smart move in your pursuit of financial security, combining growth opportunities with regular dividend income. Stock number 5, tech stocks with growing dividends. Companies like Microsoft, Apple, and Intel may not have the highest initial dividend payments, but they offer something even more appealing: steady growth in their dividends over time. These tech giants lead their industries, supported by strong cash reserves that allow them to consistently raise their dividend payouts. This combination of growth and stability makes them attractive choices for investors. What's really interesting about dividend growth stocks is how they can change your investment over the years. While you might start with a small dividend, the company's growth can lead to significant increases in payouts. This steady growth can turn into a reliable source of income, making tech stocks a great choice for long-term investment. Imagine watching your dividends rise alongside the innovations of these leading companies, feeling satisfied as your financial portfolio grows. As you look deeper into the world of tech stocks, you'll see how dividend growth goes hand in hand with innovation. Companies that keep improving their products and services often see their profits increase, allowing them to reward shareholders with higher dividends. Founder of Amazon, Jeff Bezos, has recognized the value of investing in established tech companies that have consistent dividend growth like Microsoft and Apple. These companies not only lead their fields, but also have a proven history of increasing payouts, making them strong options for long-term growth. Here's a bonus tip to help you maximize your returns: reinvest your dividends. If you're looking to maximize your investment returns, one of the most effective strategies is to reinvest your dividends. Many brokers provide dividend reinvestment plans, or DRIPs, that automatically use your earned dividends to buy more shares of the stock you own. This strategy allows you to leverage the power of compounding, which can significantly enhance your earnings over time. When you reinvest your dividends, you're essentially purchasing additional shares without having to put in extra cash. These new shares will, in turn, generate dividends themselves, creating a cycle of growth. This approach is not only straightforward, but also a powerful way to accelerate your wealth accumulation. By consistently reinvesting your dividends, you can build a larger portfolio over time, leading to greater potential for financial success. A well-known person who utilizes dividend reinvestment strategies is Peter Lynch, the legendary investor and former manager of the Fidelity Magellan Fund. Lynch is famous for his "buy what you know" philosophy and is known for advocating a long-term investment approach, including reinvesting dividends to grow wealth. That's a wrap on our top high dividend stocks for 2024. Whether you prefer stable utilities or exciting tech, there's something for every investor. If you found this video helpful, hit that subscribe button to join our community for more investing tips. Don't miss our next video, How to Invest in Real Estate with $1,000 or Less, a step-by-step guide. It's a must-watch for anyone looking to dive into real estate without breaking the bank. See you next time.